Okay, there's that term basis again. We used that last chapter when we were talking about depreciation. In order to determine whether or not there is a gain or loss on the disposal of an asset, we have to determine what an asset's basis is. That's our first step in the calculation of whether or not we have even a gain or loss. So just from a very basic standpoint, if our basis, that's a bad one. It's gonna be hard to erase too, I can tell. Yep. Ugh. Some of these, I don't know what's the, that's bad. I think it's back here. Why does it be back here? Okay, let's see if any of these are gonna work. That one might be alright. Okay, so we start out with our basis, which is gonna be our cost, what we initially paid for it, plus all those, installation fees, taxes, all of that stuff. Plus any additions or improvements. Added to it, any additional amount that increased essentially the value of it, minus depreciation. Is going to get us to our adjusted basis. This is the amount that is going to be used to determine whether or not we have a gain or a loss. So for example, let's just say we paid $100,000 for something. We added $20,000 of value to it somehow, and we have depreciated it by $30,000. Now its adjusted basis is $90,000. We sell it for $120,000. Now we have a gain of $30,000. If we were to sell it for $80,000, then we would have a loss of $10,000. How we treat this gain or this loss depends on, well, it depends on several factors. It depends on how we used that asset, right? Was it a capital asset? Was it a 1221 asset? Was it a depreciable piece of depreciable property, a 1231 asset? Was it a piece of land? So how we treat those is going to depend on not what the property was, but how it was used. Okay? A couple of terms that we want to discuss in here. Let's see. So that goes there. Oh, I guess a couple of things that they talk about as well. So the lower the adjusted basis, the greater the potential gain will be when the property is sold, or the less the loss is going to be. And that makes sense, right? So the higher this is, the lower this is going to be, the higher this is going to be, right? Okay, so we kind of went through this in an earlier chapter as well. Depending upon how you obtained the asset will also determine what the basis of that asset is. So remember, if you inherited the asset, then it's going to be, the basis is going to be whatever the fair market value was of that asset on the date of death of the individual. If it was a gift, it's going to be the fair market value that it was in the hands of, or the basis in the hands of the person who gave it to you. So that basis is just going to transfer over. If it was in exchange for services, so you gave me a truck in exchange for $12,000 of accounting services, the basis in that truck is going to be $12,000 because it's going to be based on the price of the services that were given up. Okay. Just talked about inheritance and just talked about gift. All right. So just kind of a real quick definitions here. So again, basis, amount of investment, starting point in determining that gain or loss. But again, we're going to adjust that basis for certain items that increase the basis as well as items that decrease the basis. Different rules for property acquired in some way other than a purchase, and then that adjusted basis, again, it's describing these additions and then also the depreciation. That would include 179 deductions as well as like bonus depreciation, anything like that, any type of depreciation that was taken. What's fair market value? Price at which the property would change hands between a buyer and a seller, in a voluntary transaction. A couple of things, terms that also we need to point out is the difference between realized and recognized. So the amount that is realized is the total amount that's received in a transaction. So in these examples here, I'm going to take this one out. We've got our adjusted basis of $90,000. We sold the item for $120,000. This is the amount that's realized. We realized $120,000 on the transaction. We got $120,000. For tax purposes, though, we recognize $30,000. So when you see the word recognize, that's what the tax implication is of the transaction. So really for tax purposes, we're not as concerned about how much is realized, other than we're using that to calculate what is recognized, right? All right. So it might be cash that's received in our transaction. So in this case, maybe we got $120,000 of cash. But there are other things that we can also get. And the total amount realized would include the fair market value of any property or services that were received, plus the amount of any debt that was assumed by the purchaser. This is where the person taking it on assumes any debt that was already there on the property. I don't know if they give us an example or if I need to make something up here. So let's just say that here we got $120,000, but it wasn't all in cash, right? We got $50,000 in cash, but we also got, let's say $100,000 building. But on that building, we are assuming some of the debt. And there was, let me do the math here, $30,000 of debt that now we're gonna have to pay on that building. Now we're just gonna take that, and we're the ones that are gonna owe on that building. So that's what they're talking about here when the fair market value of any property or services received plus the amount of any debt that was assumed by the purchaser. Actually, I should add that in. I'm thinking of this opposite though. I'm thinking of the fact that
There is an example further down.
is there an
the page,
example?
yeah.
Okay, then I don't have to make one up. Thank you.
Yeah.
It's hard to do that off the cuff.
Yeah, it's on 7-2.
Okay, cool. Really simply, so if the amount realized is less than the adjusted basis, it's a loss. Amount realized is greater than the adjusted basis, it's a gain. Personally, I think it's easier just to, I don't know that it's easier to think of it in these terms or not. But that's there for you if you want. Let's see. So again, amount recognized is the amount that's going to be recorded for tax purposes. Gains and losses can be realized and recognized, or they could be realized and not recognized. They could be, or it could be delayed, like recognized at some other point in the future. So like in a trade, if there's a non-taxable exchange, then all you're doing is putting off the recognition of that gain to some future time, okay? So example, if the adjusted basis of property sold is $8,000, the amount realized, so the amount of cash, is $10,000, then the gain is $2,000. Makes sense? You sold it, it had an adjusted basis of $8,000, you got $10,000 for it, you got a gain of $2,000. In this case, we have to recognize that gain if it's not from a non-taxable exchange. If the adjusted basis of the property sold is $8,000, the amount realized is $7,000, then there's a loss of $1,000. That's sort of the same example kind of as what I went through up here. If the loss is from the disposition of personal use property, the $1,000 is not recognized. Okay, so that's an important point. So your personal car, you paid $20,000 for it, and you don't depreciate it because it's personal use, just personal, you're not using it in your business. You end up selling it, you use it for 5 years, and then you end up selling it for $10,000. Well, you didn't depreciate it, so your adjusted basis would still be $20,000, and if it were a business, a piece of business property, you would have a $10,000 loss on it because you only got $10,000 for it, you paid $20,000 for it, and that was your adjusted basis. But because it's personal use, you don't get to recognize any loss on it. So you do not get a tax benefit from personal use losses. You are supposed to recognize gains though on personal use property. Does everybody do that? No. Most property doesn't appreciate anyway. It falls in value, so it's not really an issue for most cases. Like think about the garage sales and stuff like that. The stuff you're selling, you paid way more for it and you didn't depreciate it, so your adjusted basis is going to be higher than what you sold it for. Let's see. Okay, here we go. Were these the ones that you said?
Yeah.
Okay, so Indra sold a parcel of land for $55,000 in cash. The buyer, the person who purchased it, also assumed a $15,000 note that was attached to the land. She originally purchased the land for $34,000. Her gain on the sale of the land is $36,000. So what it is, so it's the $55,000 in cash that she received, plus she received $15,000 of benefit because now she doesn't have to pay that loan off. She no longer has that loan. She's $15,000 richer because she doesn't have to pay it, right? So $55,000 of cash plus the amount of the loan that was released minus the $34,000 basis for the land when she purchased it. Okay, so any amount that I was thinking of it from the other perspective of the seller, not the buyer when I was doing that. So when the seller has to then include any release of liabilities in that, because like I said, now they don't have to pay that anymore, right? They're released from it, so she's essentially $15,000 richer in this. Larry needed cash and sold a parcel of land for $55,000. The buyer of it also assumed a $15,000 note that was attached to the land. He originally purchased it for $72,000, so now he's got a loss on that, but the loss is going to be less because he also was relieved of that additional debt. So $55,000 cash that he received plus the $15,000 minus the $72,000 basis. So his total loss now is $2,000. Does that make sense? To calculate the loss? The first example was a gain, the second example is a loss. All right. Let's see. I had mentioned this. So how the gains and losses are reported depends on how the asset was used more than not what the asset is. So a piece of land could be a capital asset, right? It could just be maybe you had an investment. You found some land, it was really cheap, and you think they're gonna develop on it, so you buy the land, hoping to sell it then at some point in the future. You're not gonna build on it, you're not gonna use it for a business, but you're just holding it as an investment for future profit. Second scenario, you have a piece of land, but you decide that you purchase in order to build a business on it. Now that land is not a capital asset, it is a 1231 asset, a piece of business property. Same asset, but how the gain or loss when it's disposed of is treated depends upon how then it was used, okay? There would also be a difference if it was your personal home was on that land as well. That would have a different treatment as well. Let's see. So if the land is used in a trade or a business, the gain or loss is reported on what's called Form 4797. This reports gains and losses on assets that were part of a business, okay? If it were an investment held in a trade or business, so now it's trade or business, but it's an investment that the trade or business holds. So say that land that you bought as an investment, you bought it through your business, right? The gain or loss would be reported on Schedule D. We'll take a look at these forms here. Okay. Also, for individual investments, so you're just an individual who has, maybe you've got some stocks or bonds or that land that I described earlier, those gains or losses are also reported on Schedule D. So if it's an investment, it's reported on Schedule D. If it's for a business, for a business asset that's used in the business, it's reported on Form 4797. Okay. Questions? Now that I've messed this up, let's see if I can erase it. All right. So that's essentially, and the calculation of it is essentially the same. You're going to start with your original cost plus any additions minus any depreciation that was taken to get to your adjusted basis.